Hello everyone, let us continue with the last portion of this particular topic, that is give the heading return on invested capital. Return on invested capital. You have invested 100. Okay. After that you have received 120. What is your return on invested capital? Over here it's quite easy to say that I have received a return of 20% on my investment. Clear? So this seems easy, but when it comes to a company, there are so many factors involved. You have to step by step you have to do the process. Clear? So there is one way to identify that whether you are creating the value for your shareholder or not. Clear? So what you will do, you will compare your return on investment with the cost of capital. Your return, you have received a return on 20%, and what is the cost of capital? Say 16%. That means what? You have created a value of 4%. You have created a value of 4% for your shareholders. Clear? So now what you are going to calculate? Return on invested capital. I will call it as ROIC. I will call it as ROIC. That what is my return on capital investment? Clear? And few people call it as return on capital as well. Return on capital. Clear? Now how you will define this? Return on invested capital, return on ROIC. How you will define it? See, first of all, you need to have the net profit after tax, because tax goes to the government. It's not going to the shareholder. Clear? And it will be divided by the book value of the total capital invested. Right now it will be divided by average book value of invested capital. See, you have taken the money from the equity shareholders. Clear? And hence the value of the equity is changing over time. So what you will do? You will take the average of that invested value. Because equity shareholders have given you $100 at 0.0, but say after 2 years its value is 130. The value of that capital is now 130. So the value of the invested capital have also increased. So what you will do? You will take the average of that invested capital, and in the numerator you have to take net profit after tax, because tax you have to give it to the government, not to the shareholder. So what shareholder is receiving at the end, you have to remove all those from this particular given numerator. Clear? We call this as a return on invested capital. Now over here, one more very important point which students sometimes miss. You have invested capital not only of the equity shareholders, you have the invested capital of the debt holders as well. Clear? So in the net profit, you have to add back the interest cost as well. Because say $60 is the money which you have used from the equity shareholders, and from the debt holders say you have used $40. Clear? So you have earned the money from both of them. Clear? So in the denominator you are putting complete $100. In the denominator you are using and putting the value complete $100 from the money which you have taken from both equity shareholders and debt holders. But if you will remove the interest cost, that means what? You are taking them out of the picture, because interest cost is going to them. This interest is going to the debt holders, and then whatever the remaining is going to the equity shareholders, that is the net profit. So if in the denominator you are keeping both debt and equity, then in the numerator also you will keep the money which is going to the debt holders. Clear? And then in the denominator you will keep the money which is going to the debt holders. Are you clear? So you have to add the interest cost in the numerator as well. Clear? So one way to calculate the ROIC is this: net profit after tax divided by the average book value of the invested capital. Clear? But we have one more another ways you can say to calculate the ROIC, that is NOPAT, net profit, clear, divided by sales, multiply it with sales, divided by average invested capital. Clear? No profit after tax, average capital, sales cut down, sales will cut down. Clear? Now these two, what they are, this one and this one. So this one is nothing but, if you look at carefully, it is a operating margin. If you are dividing something by the sales, it will become what? After tax operating margin, or you can say operating margin after tax, clear. And this one is capital turnover, means by putting up this much capital, how much turnover you are making. After putting this much capital, how much turnover or asset turnover are you making. Clear? Capital turnover or asset turnover. So if suppose in the exam no information is given about NOPAT, sales, average, IC, but they have given you operating margin after tax, and they have given you the capital turnover, multiply them and you will get your ROIC. Clear? So ROIC is the product of operating margin after tax and invested capital turnover. Clear? So if I am a company, I want to increase my ROIC, what I can do? I can improve my operating margin after tax, or I can increase the capital turnover, or I can increase the capital turnover. Clear? So what I'll do, I will compare, being an analyst, I'm an analyst, what I'll do, I will compare ROIC to the investors required rate of return. If the investors required rate of return is 10%, but I am generating 12%, that means what? This is a very good investment. Clear? And I'm adding the value to the shareholders wealth. Clear? Now there is one more point which I want to discuss over here, is that NPV and IRR is not publicly available because they are related to the given project of the company, and company take thousands of projects, so they will not disclose the NPV and IRR of each and every project. But ROIC, it's completely purely available from the balance sheet and the profit and loss statement which they issue annually as well as on the quarterly basis. Clear? So for the outside investor, they will take the decision based on ROIC rather than the NPV and IRR, because they are not readily available and they are project specific. So how they are going to impact the organization, it's readily not available. Clear? So if I have to decide that whether I should invest this into this project or not, I will calculate its ROIC. Suppose ROIC is 15%, but my required rate of return is 25%. So will I invest in this company? No. Are you clear? Now, can you use ROIC to compare different companies? The answer is no. Why? Because the value is coming from the accounting methods, accounting treatments. So there is a possibility I might use different accounting methods. You might use different accounting methods. Clear? So the ROIC might be differ. Clear? So I cannot use ROIC to compare the two companies or two or more companies. Now it's a backward looking means you are calculating ROIC from the previous year data. You don't know that the company will follow the same ROIC next year as well, because this ROIC is for the previous year. What if the next year company will not perform well, their sales are low, their expenses have increased a lot, their input cost have increased, so they will not be able to maintain the same ROIC. So it's a backward looking. Clear? It can be volatile from year to year. Clear? And this ROIC is completely for the whole company. Clear? So they might be having some profitable projects, some good decision, and there are some unprofitable projects as well as poor decision as well. So overall as a company you are getting ROIC. So what if the next year company will take up some poor projects with poor decision, hence the ROIC will start decreasing. Clear? So we have completed all the points of this particular topic in detail, and all the 5 lectures have been given to you with this. Clear? I'm ending this lecture here. Thank you.